It's crazy. This just goes so far. If you will erase the emotional attachments to the fear of a higher payment, the concern of all this crap, like just get objective with it and know that there are insane strategies that you can use to seriously change the trajectory of your financial future. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Brock Lassick, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
So welcome back to part 3 of the 3-part series, Optimize Leverage, Mitigate Risk, and today, Maximize Wealth, which I feel like both of the previous episodes were full of a lot of meat that had to do with those two things, but we've been chomping at the bit on each one to talk about Maximize Wealth.
Yeah.
Because that's like that really is the end goal of all this, is how do we position our clients and people in a way that they can maximize wealth through the power of homeownership and mortgages, but not put themselves and their families in a place of undue financial risk that could just wreck the whole entire plan anyway if you're not prepared to sustain financial shocks. So we covered the optimized leverage piece, which frees things up, enables you to mitigate risk, but then ultimately flies into this idea of maximizing wealth. And there are so many different directions we can go with this. So I hope we remember to hit them all.
Yeah.
But it's like maximize wealth by virtue of the real estate and ROI there, by virtue of reinvesting the freed up capital, by virtue of reinvesting and dollar cost averaging because we paid off debt through risk mitigation. There's so many different directions we can go. So I just kind of want to nerd out and dive into those details.
Yeah, we might have already touched on some of this too, just because it's all so intertwined.
Yeah.
But I think it's good just to go over everything again in terms of maximization.
Mm-hmm.
The main thing that stands out to me first, and this is the crux of a lot of my conversations with borrowers when they first come to me, is whether you own 5% of your house or 50% of your house, it still appreciates at the same rate. So then they put less money down. Then what do you do with the cash?
Mm-hmm. Mm-hmm.
So, and that's...
Well, let's just hit on that.
Mm-hmm.
To be crystal clear on exactly what TJ's saying. The home itself, it's a $500,000 house. Let's just say historically, homes appreciate at about 5% per year. That means that $500,000 house in year one will appreciate at $25,000.
Mm-hmm.
That's not going to change if you put $25,000 down, which is 5% to begin with, or you put $500,000 down, which is 100% down to begin with.
Mm-hmm.
No matter what, either way, that asset, if we just ignore the fact that it's a house with a mortgage and an expense attached to it, that asset is going to grow at $25,000 per year, or at least year one under these assumptions, no matter what. So if you ignore the emotional attachment to, oh my gosh, the house payment's so high, oh my gosh, this is so scary, oh blah, 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 all these emotional concerns, ignore that for a minute. And let's just reframe this and say, okay, if you give me $25,000, in 1 year from now, I'll give you $25,000 back, and you'll retain the $25,000 investment with me. And the next year, I'll give you another $25,000, compounding
on top of that $25,000. Yeah, right.
And it just keeps going forever and ever. Or I say, alternative option number B, I say you're going to invest with me. Ignore the fact that this is a house for a minute. Give me $500,000 in cash, and in a year from now, I'll give you $25,000. And the next year, I'll give you $25,000. If my return doesn't change, why in the world would you ever give me more?
Well, yeah. I mean, it's it's just numbers.
It's so logical if you think about it that way, but it is so illogical when people get freaked out and hyped about, oh my gosh, it's a mortgage. Oh my gosh, it's an expense. Oh my gosh, there's so much risk. What they're missing is going back to the last episode of mitigating risk, which is if you got liquidity, it's less risk.
Yeah.
than if you had a lower payment or no payment. Well, maybe not no payment at all,
Right.
but it's certainly less return in that case. So I just wanted to.
Well, think about it this way. You put down, say you're buying a $500,000 house, putting down $25K instead of 20% down, which is $100K. Well, your return on investment in that 1 year's time is 100% if you put down that $25K because you're getting it all back. Whereas you put down $100,000, what is that? What is that return on investment?
25%.
25%.
So literally your return on investment
is less 1/4 with putting more down.
And the cool thing about real estate, which this is why it's such a critical piece to the puzzle of maximizing wealth, in my opinion, in our opinion, is that could theoretically be tax-free forever.
Right.
If you have your plan set up, if you have a trust set up and you're working with an estate lawyer and you've got all these things dialed in and you're leveraging the tax code and everything to your best advantage, these returns that TJ's talking about, 100% return on investment, for example, could literally be tax-free for you and your heirs forever.
Yeah.
They're like, I challenge you, go pull up any of your brokerage accounts, your crypto accounts, your 401k accounts, your money market account. Go pull up any sort of investment account you have, and I am like 99.999999999% positive none of them come even remotely close to 100% return on investment, probably not even 25% return on investment. My bet is it's somewhere between 10 to 15%.
Yeah.
On all these other assets that people are totally willing to dump their money into.
Yeah. Well, and it's also cool. You're putting in 25K, but you're making money based on 500K. What stock can you buy that you put in 25K in the stock and make money based on the based on the whole worth of the portfolio?
Yeah.
It just doesn't exist.
Put in 25K in the S&P 500 and you make a return on the full 1.7 trillion
exactly.
of the value.
If that's the case, sign me up.
Yeah. Well, and to your point, it's so unique because, like I was just expressing, there's tax advantages and there are ways that you can amplify this investment.
Yeah.
Far beyond any regular investment.
Well,
like if you're
and then leverage it later on too.
Yeah, exactly. Yeah. And recapitalize later on as it comes up, or sell and 1031 into something different or whatever.
Yeah.
But if you are as it sits today, if you're considered a real estate professional, spending, I can't remember exactly the rules, but a certain number of hours per year in the real estate game, managing real estate, selling real estate, something like that, you can take depreciation on the property, and there's a thing called accelerated depreciation or a cost segregation study that gives you the accelerated depreciation numbers. And like, there's people that'll go buy a $400,000, $500,000 house, and year one, they acquire the property. Year one, they write off like $200,000, and that $200,000 goes against, if you qualify, against your income. So you don't pay income taxes, even regular income, not just capital gains. Don't pay income taxes on $200,000. Well, assume you're at a 35% tax bracket. That's $70,000 in income tax savings.
It's crazy. On
the acquisition of the property. That's probably equivalent to what you invested as a down payment to buy that house. So literally, as long as you can float it by the end of the year, you just recouped your down payment. So with tax savings, I mean, hell, you're practically financing 100%.
Yeah, it's crazy.
Like,
it's stupid.
And then the returns are infinite.
Yeah.
It's wild.
I guess the next question is, so you've put less money down in the house. What do you do with the extra cash?
Exactly. And of course, like, I think we have to caution everybody with the fact that we have our own ideas.
Yeah. We're not financial planners.
Yeah, we're not financial advisors. We aren't licensed to do we're licensed to do mortgages, no other financial services. We're not giving advice. We're just talking about concepts, theories, ideas that then you can take to the pros in these other areas of finance and leverage the cash. And we do it in our own lives with our own real estate, with our own money. And that's where our ideas come from.
Yeah.
And so that's really what we're sharing. But I mean, you and I are similar. I just basically want to reduce my cash flow or reduce my overall monthly expenses so I have more cash flow monthly. So dollar cost average into the market.
Yep.
S&P 500 is where most of my money sits. That's not in real estate or private equity. Just dollar cost average. It's easy passive investments into the United States, which I live here. I love the United States. It's what I believe in. That's why I invest there. And it's just simple. But then when I have larger chunks of capital, say I sell a house, does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962 and get a bunch of cash. I don't just sweep all that equity into the new one. I sweep enough to optimize my leverage, optimize terms, which is step one. And then I take the rest and maybe buy another. I've bought real estate with some of my proceeds from other sales. I've gone into private equity deals. Some of it I've actually just lump summed into the market if I feel like it's a good time to invest. And the fact is, like when you got time, you and I've got time. I don't need my money for 30 years. You don't need your money for 40 years. Like, who cares if next year the market goes down? It literally doesn't matter because 30 years down the road, it's all going to mean
you're banking
nothing.
on historical averages right now. I mean,
100%.
there's going to be ups and downs, but the history speaks for itself.
Yeah. So dollar cost averaging in with cash flow savings, which we've talked about.
Well, let's run a scenario.
Okay, yeah.
So on that same $500,000 house,
Yep.
you're going to put down $100,000 instead. You put down 25.
Okay.
So you've got 75K to let's say throw it in the S&P 500.
Okay.
And historically, the S&P 500 almost gets a 12% return. Let's stay a little bit conservative and say you're getting a 10% return.
Yep.
Over the course of 30 years, you almost have $1.5 million in the bank, plus a home owned free and clear at that point.
Yeah. And the home is going to be free and clear either way, whether you put a bunch of money down or less money down.
Yep.
So really, the idea here is in the maximizing wealth piece of this is what you're buying into is that $500,000 house. You're agreeing to spend about $500 extra per month on your mortgage, which, bear in mind, in large part provides some tax benefits and some incentives. You can if you qualify for a $500K house, you can very, very, very likely afford $500 per month. It's just a psychological decision. You have to understand that's really an investment. You're not opting for a cost. And that $500 per month investment, if you let the other $75,000 ride for 30 years, which in real estate, you would let it do that anyway because it's illiquid in the real estate, you become a multi-millionaire from a cash basis and you still end up with a free and clear house at the end.
And then you could take out, I mean, once that 30 years hits, you can take out $6,250 a month and never touch the principal. You're living off the interest.
And that's after tax.
Yeah.
$6,250 per month after tax for eternity.
Yep. Yeah.
I mean, it's insane.
Damn good retirement plan, if you ask me. I mean.
And think about this. So remember, that house that you bought is going to be worth over $2 million, and you're older, and you likely could downsize.
Yeah.
So now, do you sell that house that's worth $2 million and go buy cash for something, or refinance again? Actually, sell that house for $2 million, go buy something new. Now, granted, the home prices are going to be more expensive there, but you downsize. You don't need as expensive as a home. You finance again, but now you just capitalized. Let's say you put $500,000 down on the next house. You just put another $1.6 million in the bank, and you more than doubled that $6,250 a month. So now you're making $13,000 a month, and the new mortgage is not going to cost you an extra $6,000 a month. If we just run the math, so it's like there's no end in sight. You could just constantly do this over and over and over again. And what I love is it's not overcomplicated. It's not overly risky. It allows you to design a life that's enjoyable to live, that's not stressful, not scary, and create obscene amounts of wealth.
Yeah. I think this is where the stat comes from. 80% of millionaires got their millions through real estate.
Yeah.
You can be an average Joe and literally make millions through real estate like this. I had a client that...
We've seen them all.
Oh, yeah. I mean, I had a client that he worked for, it was airport security.
Okay.
So, I mean, a good, secure job, but he wasn't making tons of money. Bought their home in 2008, so they had a lot of equity and then had a really low rate. But they grew out of that home, didn't really want to have the higher mortgage payment. But after meeting with me, they got a much nicer house And yes, they have a higher rate, but now they're debt free. And
that's the crazy thing that so many people miss,
right.
which we've got to hit on. Finish your thought.
But then by the end of it, he's going to be debt free. But then by the time he paid off his house, and we put him on a 15-year note on the next one.
Oh, wow.
15 years, he was going to have over $1.5 million with all the equity he had from the vacating residence in the S&P.
So invests the equity, 15 years instead of 30 years, still has over $1.5 million. House is paid off free and clear, and he's 100% debt free. Exactly. So in other words, my bet is, just because I understand this like you do, he probably walked into this with not any more money out of pocket on a monthly basis to buy this new house because you wipe the other debt out.
All the other debt, yep.
It's insane.
Yeah, and they didn't have a plan for retirement other than the 401k, of course.
Right. But which they probably weren't contributing much to anyway.
No.
Almost none of our clients.
No, the majority of their net worth, when it's all said and done, will come from the S&P 500.
Yeah.
It's crazy.
And this free and clear house.
Yeah, of course.
Down the road. Which is, I mean, it's nuts. And that's, I think, what some people miss as well. Because a deeper nuance to that little plan that TJ created for his clients is he enabled them to buy a more expensive home. So what was their home they sold? What was the approximate it had to have been like 500,000. And then the new house?
Closer to 700.
700. So now they own a piece of real estate. So they have more cash. They have probably less money out of pocket every month on a monthly basis. Or you did a 15-year loan. So maybe the same money out of pocket.
Yeah.
So they
paid off a lot of debt. I mean, we're talking they had 3 auto loans, a trailer, and credit card debt. Yeah,
so they eliminated all that, got their new loan on a 15-year fixed mortgage, fast-tracked the payoff of their mortgage compared to the last one. They're paying no more money out of pocket than they were paying, and now they own a piece of real estate, or an asset, in other words, that is $200,000 more valuable than the previous one they owned. And because of all the other debt, because they weren't optimizing leverage, tapping into that equity and doing it the right way, they were paying the same money out of pocket. So we literally just, maximizing wealth goes so much deeper because not only did the cash turn into $1.5 million in 15 years, they pay off the house, so on and so forth. They now own a home that's worth $200,000 more. So that home compared to their $500,000 house that they sold
in 15 years time.
Yeah, in 15 years, $200,000. Assuming a 5% appreciation rate, 15 years, they made an extra $220,000 in equity on this home. So in 15 years, they more than 2x'd the added asset. So they made $220,000 in additional wealth in 15 years.
And they're living in a nicer home.
Yeah, exactly. Not to mention the lifestyle benefits.
Yeah, exactly.
And maybe they've got more energy, or maybe the network of their neighbors is better, so they have more financial opportunities in the future. Like, there's so many peripheral things that we can talk about. But it's like, it's crazy. This just goes so far if you will erase the emotional attachments to the fear of a higher payment, the concern of all this crap. Like, just get objective with it and know that there are insane strategies that you can use to seriously change the trajectory of your financial future. I mean, just that in 15 years for most families to have an extra $220,000 in wealth. And it costs them literally nothing.
Yeah.
It costs them not one penny more. We just created $220,000 in wealth for them, not to mention the $1.5 million because they strategically reinvested into other assets.
And that's with the rates sitting where they're at right now. I mean, what if rates go down and they can refinance and then they've got a couple $100 more per month liquid? You can then take throw it back in the market and just compound this even further. Really, the sky's the limit.
It's crazy. But anyway, this is a powerful one. We're very passionate about this. What I will say is this 3-part series hopefully gives you a taste on what our holistic mortgage planning strategy is all about. It is very nuanced, very detailed, but we get stoked about this, and we want to help people through this. But every situation is unique. So I would encourage you all, if this is something intriguing to you, call our team. We can do a consultation with you. We can craft a mortgage plan with you. It doesn't cost you anything. Our hope is we just develop trust and relationship and earn the opportunity to help you with mortgages into the future. But we can help kind of paint a picture of what this looks like in your life, because we're just kind of shooting in the dark here, trying to come up with ideas and trying to paint strategies that have worked for other clients in the past. But there's countless other versions of these stories.
And no one client's the same.
Exactly. And they all work out so well.
Oh, yeah.
And most of the time what happened, I mean, I would say 99% of the time, the clients are like, holy crap, this is so simple. This makes so much sense, but I never even considered looking at it this way.
Yeah.
So it just like takes somebody who's done the work we've done and created the strategies we've created to paint a clear path to these solutions. So anyway, that's all I've got.
And one thing to add, it doesn't have to be an instant thing. You don't have to buy tomorrow. Like this can be a strategy that maybe we start setting up now, but maybe it's 6 months, maybe it's a year, maybe it's 2 years down the road before we actually deploy this. But at least you know what you're walking into with your real estate strategy.
And at least every day you're making moves with some intentionality behind them. There's a purpose, a rhyme, a reason, not just like, well, I mean, I don't know. I guess I'm ready to buy because everybody else is buying, or
exactly.
like there's a reason for it.
Yeah.
And it's more of an objective, pragmatic decision, not an emotional decision, which sad to say, but almost all the decisions made in real estate or any investing are based on emotions. Yeah. And that's why people lose and rarely create wealth. So
no, it's true.
Anyway, well, thanks for tuning in. Be sure to follow, like, subscribe, comment, all that stuff. That really helps us reach more people. So we would appreciate that. Keep an eye out on our website, loanselevated.com. We're going to be launching a book on holistic mortgage planning, which is going to go into all of these concepts, but in a book style, probably a bit deeper than we could ever be able to explain here on a podcast. But yeah, thanks for tuning in.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.